Spotify is trading under ticker SPOT, and it's currently priced at $620.72 a share. But why should you care? Well, it's up nearly 7% over the last 5 days, 61% over the last 6 months, and 117% over the last year. But it possibly can't go any higher, right? Well, here's the catch. Given its recent headlines, upcoming earnings report, and its sustainable business model, there's still a lot of room for growth. So with that said, let's get into some of the details. So Spotify plans to raise subscription prices in dozens of countries, mainly Europe and Latin America, this summer by about €1 per individual subscription. But you might be wondering, didn't they just raise prices in the US last summer? Well, they did, in July of 2024, but this latest increase targets countries outside the US. So why is this all happening? Well, music industry executives have pressured Spotify and competitors to raise prices, saying subscriptions haven't kept up with inflation. Despite previous hikes, Spotify remains relatively cheap compared to video streaming services like Netflix. In addition, the music industry's growth is slowing globally, leading to a push for Streaming 2.0, a more expensive, premium tier option with extra perks like early access to music. But what does this all mean for the stock price? In Spotify's 2024 10K, premium revenue accounted for about 87% of total revenue. So what does this mean? Well, price hikes equal immediate top-line revenue boost without needing a proportional subscriber increase. And gross margin improvement is also in effect. In the 10K, Spotify mentioned gross margins improving partly due to price optimization and cost control. So higher subscription prices in large markets, even without new services, will expand gross margins even further. But there comes user churn risk. Spotify's 10K warns about price sensitivity, meaning churn, and subscriber cancellations. So this could rise if users push back against higher prices. However, since the increases are not happening in the US right now, which is Spotify's biggest market, and Europe is generally stickier for subscriptions, churn risk should be manageable for the short term. Now there's one more thing, a super premium feature which Spotify is looking to introduce in the near future. So even though the super premium feature costs $6 and isn't live yet, if teased during the earnings call, investors may price in future revenue growth. And Spotify's 10K stresses innovation and monetization of the subscriber base, so super premium aligns perfectly with this strategy. In terms of its valuation, Spotify is currently trading at a forward PE multiple of around 56. But you might think, why is it at such a premium? Well, historically, Spotify operated at razor-thin or even negative margins. Now, they're shifting to a profitable, high-margin business model, and revenues are still growing in double-digit figures of 10 to 15% on average. They are also the only pure music subscription platform on a global scale. Apple, Amazon, and YouTube all have music divisions, but Spotify is pure play focused, making it attractive to specific investors. But what is the potential risk with such a high valuation? Well, if growth slows down, then their valuation will compress quick. In addition, if the churn rate increases, where customers are starting to cancel their subscriptions because of increasing prices, future earnings can start to miss targets and also cause significant drops in valuations. But in simple form, investors are paying up now because they believe Spotify's earnings will grow explosively over the next 2-3 years. The average price target for Spotify currently sits at $671.41, with estimates ranging from a low of $458.40 to a high of $798.30. Out of 25 analysts covering the stock, the overwhelming majority are bullish, with a combined consensus of buy or strong buy ratings. The strong analyst backing, combined with Spotify's margin expansion story and upcoming revenue catalysts like price hikes and a new super premium tier, suggests that Wall Street sees significant upside potential from current levels. Therefore, Spotify's strategic price hikes and potential for super premium tier suggest strong growth ahead, making it a compelling stock for investors despite its current high valuation. As always, thanks for watching, and don't forget to like, comment, and subscribe for more insights. Thank you.